Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is Monday, and it's October 3rd. And all I can say is, thank goodness, September is now in the history books. It was a really difficult month for the market. There's no doubt about it. And Friday was no exception. We had, end of the month portfolio, especially amongst pension funds, rebalancing. It wouldn't surprise me if you saw quite a bit of selling of what they hold in equities and moving over into the bond market. We'll be able to check that out later on, in the month when we start to see where pension funds were headed. But the point here is it was a difficult month. So that brings us now to October. So here's some good news. The pessimism in this market is palpable. You can feel it. You can see it in some of the surveys that we look at. Also, in terms of this market, what you have is an oversold market. And I want to just go over very quickly what that means. It means, if I want to just get real general about it, there was just too much selling. There are all kinds of metrics that many of the technical analysts look at, and every single one of them has a check. Oversold, oversold, oversold. And the reason is, on a very pragmatic basis, look at all the days that this market has been selling off. By the way, it can go on longer than you would expect, right? The same way overbought. You'll be hearing, it's overbought, there's been too much buying, it's pushed the market up, up, up. That can go on too for quite a while. But normally what happens is, in an oversold market, something comes along that serves as a catalyst for a rally. And what do I mean by that? Well, let's look at it. One, we're going to be going into the earnings season in just about a week and a half. Well, I can just tell you this, that we have had more negative estimates. In other words, analysts coming in and lowering or downgrading their estimates than we've seen in a long, long time. That's one reason that everyone is so negative and so, this is not going to go well. Yeah, I can see that. But what about this? What about if we get positive surprises, which we always do? No matter how horrible things are, we always get positive surprises. That could serve, by the way, as a catalyst. That company comes out and says, hey, we're doing very well, and the guidance is strong. Or you get a couple of companies doing that. That could be. Now, it can happen, I just want to point out, before the actual onset of the earnings season, because that's what I'm talking about between now and the opening of when we do the financials. So that's one. Second, how about this? How about in the world that we're living in right now, bad news is actually good news. Why? Because if you have a bad data release, in other words, things slow down. And how about this on Friday? That we don't have as many jobs as we thought we were going to have. That sounds awful, but in the translating it into the eyes of the Fed, that would be a good thing. Anything that slows down demand, anything that slows down the economy will be seen by the market as the Fed is doing its job. And therefore, maybe, just maybe, we'll be able to slow things down a bit. In other words, not 75 basis points for the next meeting, maybe 50, and then we go to 25 or 25. So that is where another possibility is, because this week we have an absolute raft of data releases, important ones. And then the other thing that we could possibly have, and that is we actually hear something that's different from one of the Federal Reserve speakers, maybe by accident, or maybe they changed their tune. Maybe it's, we are watching the global situation for any fault lines. By the way, on Friday, Lael Brainerd, who is the number 2 at the Fed, she's the vice chair, made a comment, and she said, look, we're not giving in. We've got to finish the job. However, she added this. She said, but needless to say, we are watching global conditions. And why would she say that? Well, clearly because of what happened in the UK and also the fact that conditions are tightening. The more the Fed is aggressive in its rhetoric, and the more the market believes we're going to have a 75 basis point hike in November 2nd at the next Fed meeting, the more the dollar rises. The strong dollar is pushing pressure all over the global world because, one, they have to basically go in, and some of them intervening because their currencies are falling too much, or they have to raise rates so that their currency rises. The only big country that's not doing any of this, by the way, is Turkey. They're actually lowering rates despite the fact that their inflation rate is double digit. So that can happen. Something comes along and gives us a rally. The question will then be, how deep is the rally? How strong is the rally? But all I can say is that pessimism is enduring right now. It's palpable. Also, what we're seeing is lots and lots of buying of put options. Puts are where I am betting, and if the market goes down, I'm protected, as opposed to buying calls where I'm betting that the market goes up. That's what we saw in the end of July and early August. Everyone thought this market was just going to go up, 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 until it didn't. So that's where we are right now. The data that we had last week, the PCE, that was the one I was paying attention to. That was the Personal Consumption Expenditures Index, the Fed's favorite look at inflation. Didn't help because even though at the headline level it came down a bit, it was still elevated. It was not enough for the Fed to even remotely suggest that inflation has plateaued. No, not at all. So we will look to this week because this week is the key, I think, for coming out and getting a better sense of where we're headed. So today, for example, we are going to get this morning the ISM, that is the Institute for Supply Management, Manufacturing Index for the whole country. The expectations are that we will be above 50, which means expansion. Okay, it may not be well above 50. It may just come in at about 52, which is where we were the last reading of this important index, the Institute for Supply Management Manufacturing Index, ISM, coming out at 10 o'clock Eastern today. We are going to pay attention to new orders. We're going to pay attention to hiring expectations, very important for obvious reasons. And then we'll also have construction spending, and we will have vehicle sales, which is also going to be important because we believe that because of the higher interest rates, sales have slowed down. And then on Tuesday, we will have job openings. We are going to have the quit rate. That's the JOLTS report, job opening and labor turnover. Why is this important? Oh my goodness, it's important because the Fed, rather than killing the labor market, which they could possibly do with more rate hikes, but what they would prefer to do is to have the job openings dwindle, because that would mean there would be fewer jobs available and that those looking for jobs would not be pushing for higher wages. That remember what the Fed is looking towards, to make sure that the higher wages don't keep going up, because ultimately they lead to higher prices. Just to give you an example, Amazon last week announced that the drivers and also the warehouse workers were going to then get a raise to $19 an hour. What does that do? Do you think Amazon is going to just say, oh, don't worry about it, we'll be fine with this? No, they will find a way to pass it along to either the other companies that are on their platform or split it with us, the consumer. That's what's going to happen. Passing along the higher wages into higher prices. So that works against what the Fed wants. So ultimately, they would love it. Really, I say love it. I know it's not, doesn't sound scientific, but they would like it very much if the number of job openings were to come down, because then people looking for jobs would not have that much opportunity, and they would not be pressing for higher wages. So that comes out. It's the job opening and labor turnover report. It's called the JOLTS report. We'll have factory orders, and we will also have lots of Fed speakers this week. Wednesday is the ADP employment report. This has been reformulated. We'll watch to see what they have to say. Last time there was only 132,000 jobs, yet we had actually a strong payroll report. The consensus is for this. It's only the private sector for 216,000 jobs. And then on Wednesday, also extremely important, is the service sector. This is, again, the Institute for Supply Management, ISM, service sector. Expectations are that it will be strong. The last reading was 56.9%. The expectations are it will be 56%. It certainly does not sound like the major portion of our economy slowing down in a material way, the way the Fed would like to see it. Then on Thursday, we get the claims report, and everyone probably knows by now, last Thursday, there was hardly any movement. In other words, we didn't see a lot of people filing for claims. And then on Friday, this is the big event for the week. It is Payroll Friday. Remember last month we had 315,000 new jobs. It surprised the market to the upside. The unemployment rate was at 3.7%. Expectations are that we will come out with 275,000 new jobs. But again, if there's a surprise upward, in other words, more jobs than the market expects, this is going to be a problem because the market is going to say, holy moly, the Fed really has got to slow things down. But of course, we're going to be looking for hourly wages, which we hope, which will level off. They did last week. We hope that we'll see it leveling off. And then we have an abundance of Fed speakers. Last week also, I want to point out, we had another important indication of the health of the economy. This time, it was actually for company spending. We saw, the corporate buying pick up, and it picked up in a way that told us that companies are saying, look, we have money, things are okay, we will continue buying. Now, that's not what the Fed wants to see. They want to see that we see durable goods, which is part of the report that it came out of, just slowing down. It slowed down on the consumer side. We knew that. But in the core part of that report, which is companies, they were spending. So the economy is strong. It's solid. And that is not what the Fed wants to see because they believe the more the economy slows down, the way the housing market is slowing down, by the way, the more we will see inflation coming down. Inflation, by the way, is coming down. I can share this with you. I just saw this report over the weekend. Containers at the ports are actually empty, not because there are no supplies coming in, but the fact is imports into the U.S. has slowed. We've seen that in China, their export numbers are down. That means that other countries are not going in with big orders, and their port activity was actually very, very slow. So that's in our world where we're looking for a slowdown to get the Fed to finally stop and level off their rate hikes. That's good news. All told, the market is bracing again right now for the November 2nd rate hike. More and more, it's looking like it's going to be 75 basis points unless something stops. What is the market worried about? Also, the market's worried about another accident like what we saw in England. What was that all about? It was actually a pension. Pensions that had dividends, options, all kinds of fancy options, and those came under pressure. It came under pressure as the U.S. dollar pressed the pound sterling down almost to equaling the U.S. dollar. The U.S. strength of the dollar across the world, as I mentioned, is putting pressure in little nooks and crannies all over. And that's the worry. That's the worry that something else is going to hit, and that something else is going to have a sense of contamination around the world. The UK, the Bank of England went back in and bought bonds, which is, again, very interesting, isn't it not? Because at the same time that they are raising rates in order to tamp down inflation, there they had to go in and buy bonds, a form of quantitative easing. They were doing both. That is not what was on the agenda, by the way. They're just supposed to be raising rates in order to slow down inflation. Also, we saw where in the European Union, the Eurozone, inflation rising to nearly 10%. This is going to force the European Central Bank to continue an aggressive campaign to weaken inflation. And this, despite the fact that the economies are starting to slow down and concerns over, the weaker countries within the Eurozone suffering from higher hikes, the European Central Bank is going to be forced to do it. By the way, that's their mandate. They only have one, and that is they must fight inflation when it rises above 2%, and it is nearly 10%. So all of this portends that we may have another break somewhere, and it could go away easily like we saw with the UK. But what happens if it is a deeper cut or break? And that's why you hear the term. The folks are worried that quantitative tightening from part of the Federal Reserve, coupled with the rate hikes, will lead to them breaking something. If they do break something, by the way, the first thing I think they will do is stop quantitative tightening. That will be their first line of defense before they actually say we're pausing or there's a pivot. So there's a lot, again, for the market to absorb this week. All of these data releases, the most important of which is on Friday, to see how strong is the economy. And also, I would have to say the ISM, Institute for Supply Management, reports in terms of what are they seeing in terms of new orders, what are they seeing in the service economy, also in manufacturing, and also employment expectations. Extremely important. I do want to point out, someone mentioned this to me, and I want to make sure that I mention this right now. There is another report that mimics the ISM. It's the S&P Standard & Poor's Global Survey. We follow the ISM. We look at the other one, but we follow the Institute for Supply Management. You can get confused when you look at both, so we stick with the Institute for Supply Management, the ISM. Have a very good week, but also be prepared for lots of pessimism and something coming along. Either bad news being actually good news, being an announcement from one of the Fed speakers. There are a whole bunch of them this week. Or an announcement from a company coming out, what we call it a pre-announcement, which is not negative, but it's actually positive. That would be good news for a pessimistic market and a market that is oversold. Thank you very much. Please don't hesitate to get in touch. Have a good week. Hang in there, and we're here to answer any questions that you may have. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.